afternoon, Realtist. Imani Smith, First Vice President of Associated Real Property Brokers here today. We have a great business development webinar going on for you today with Payne. But before we get to that, I just wanted to new homeowners in the next 5 years. We are working tirelessly and trying to be creative with getting our clients into the homes. So today's webinar will be introducing another way that we can get our Black folks into home ownership. Now we have this webinar every first Wednesday of the month, so please stay tuned for the rest of the year. We have a lot of great topics in store for you. We also hold our monthly marketing breakfast every third Wednesday. www.arpbrealtistoakland.com for more information and to also be on our mailing list. Now this afternoon I have with us Mr. Harry Payne, who is a Board of Directors for Associated Real Property Brokers. And thank you so much, Harry, for joining us today.
Well, thank you, Imani, for allowing me to come and share this information with the folks out there in the audience today. Good afternoon, all. I'm Harry Payne. I'm the Division Sales Manager for Primary Residential Mortgage, Inc. I am responsible for all that's going on here in the Bay Area. We are a national mortgage bank located corporate headquarters out of Salt Lake City, Utah. And we are in 49 of the 50 states with over 280 branches to serve our communities out there. I have been in the mortgage industry now for over 30 years, and it has been my goal and my service to be able to work with our first-time home buyers in our community to get them into their first homes, and then of course which springboards them into all these other possibilities. Today we're going to be discussing the renovation products, specifically the FHA, what's called the 203K loan, which again allows for someone to purchase a fixer, for example, that is below market always. It's a fixer. And fixers can be defined as properties that not necessarily need particularly repairs, but upgrading. The home may not have been upgraded since the 70s, for example. And we're talking about upgrading the bathrooms, the kitchens, things of that nature. Likewise, a fixer can be something where the home is burned down and it's left with pretty much just the foundation. The renovation 203K, or we call it 203K, can also be used for that purpose, to purchase that property and to build from there. So we're going to talk about the renovation first product. There are two categories of the renovation loan, the 203K. The first one is the FHA financing, 203K. And what that allows our buyers to do is purchase a home, and let's say the home only has one bedroom, and two bedrooms, and they need 3 or they need 4, or they need the basement to be finished for additional living space. The 203K FHA loan will allow for the purchase of that property, no matter what the condition is, and for you to purchase it, and we will give you, within the same loan, the renovation funds to renovate that property so that it's move-in ready. One of the benefits, in particular, of the 203K is the down payment requirement. Like other FHA financing, it is only required that you have 3.5% down of your sales price and whatever it costs of renovation. So what we're saying is, if the home is $100,000 for easy math, but you're looking to put $50,000 in renovations, or $30,000, let's say, in renovations, then you would need 3.5% of $130,000. So it's the cost of the price of the home plus the amount of renovations that you're looking to complete, and you would simply need your 3.5% down payment. Of course, closing costs are extra, which can always be paid by the seller, for example, or out of your own funds. One of the great things about the renovation product is that it allows you to take a single-family home that is currently single-family, and you can, in fact, convert that to a duplex, a triplex, or a fourplex. Likewise, you can go in reverse able to also convert, again, your unfinished basement into a living quarter, which is great for additional housing. We call those out here in California accessory dwelling units, or ADUs. When they get older, or even for yourself, if you're older already and you don't want to move from your property, um, that is available. Additionally, any detached garages, the FHA 203K doesn't really deal with detached property like the garage, but the Fannie Mae version of the 203K, which is called the home style. That's one word, home style. The home style 203K product does allow for you to do luxury items like add a swimming pool, for example, or you can add a second level to an existing garage so that you have a bonus room, for example, upstairs. Now, you are not able to, at this time, you're not able to finish that second level as a living quarters, not with the renovation funds. However, after you have created the second level, you can use outsourced funding, such as maybe pulling cash out of a property, or proceeds from your sale of the home that you just sold, or funds that you may have in other savings, to go ahead and then finish the upstairs level to convert it into a living space. Just can't use it out of the renovation funds. The 203K does not, one of the benefits, of course, is being able to purchase these fixtures, which a lot of first-time homebuyers always inquire about with their realtors, and they're, more importantly, in this case, our realtist. They want to know, hey, I want to get a fixer because they're always cheaper. What they don't understand is that not all loan products will allow, particularly your traditional loans, such as your Fannie Mae or Freddie Mac's conventional loans, or an FHA traditional loan. Those must be able to, those properties with those loans need to be able to pass the property condition inspection by an appraiser. Whereas with the 203K, they do not. Any repairs and any repairs that are required, they can be incorporated as part of the renovation funding. So once again, one loan, i.e. your 30-year rate fixed mortgage, and within that loan, you are able to, we will fund the purchase price of the home minus your 3.5% down payment, and we're able to then give you the renovation funds above and beyond that number. Now, the FHA has two versions of the product. They have a limited version, which allows you to renovate the property, predominantly upgrades. So we're talking about non-structural things. So we wanted to upgrade the bathroom or the kitchen. That is absolutely fine to do so. Whereas, and again, with FHA, everybody, please keep in mind that it must be a primary residence, meaning you plan on occupying the property yourself. This is your primary residence. That is key to remember about the FHA product. So you have the FHA 203K Limited, which takes you up to $35,000 in total renovation or upgrades that you're able to use. The second version is if you're looking to add units and or do structural work where you're tearing down walls, things of that nature, or adding rooms. That would be the standard FHA 203K product. And that will allow you to fund up to whatever you are qualified for. There is a maximum loan limit here in California, which is $729,650. So you can finance up to that loan amount, $729,650, and then any funds above that would be your down payment. So that's the FHA product. Then there's Fannie Mae, which is one of the conventional agencies, and their 203K product again is called the Home Style. And the Home Style does a little bit more than what the FHA product does. The first difference is the Home Style can be used for investors who are interested in purchasing single-family homes. They can't buy a duplex, triplex, or fourplex with it, but they can buy a single-family home and renovate it as an investor. The down payment for investors on that would be 15% down payment. When it comes to credit scores, what you want to know is that basically FHA is looking for a 640 or better credit score. And when we say credit score, we're talking about your middle score. So from a lending standpoint, we pull all three of your credit bureaus, Equifax, TransUnion, and Experian. And whoever is in the middle, meaning numerically, that's the score we're going to be using. So as an example, if one score is 700, another score is 625, and a third score is 650, we would toss out the highest score, the 700, and we would toss out the lowest score, which would be 625. And what's left is that middle score of 650. So that is the middle score that we're referring to when we talk about where your credit score needs to be. And again, with FHA, it is a 640 credit score or better. And with conventional, interestingly enough, it's actually only a 620 or better. Now, having said that, one of the things that unfortunately that is not available right now, because I'm asked this a lot, because we do a lot of down payment assistance, is down payment assistance available with the 203K loan product? And unfortunately, the answer is no at this point. The down payment agencies haven't really gotten that sophisticated yet, so you would need your own down payment. With FHA, of course, they always allow for gift funds from a family member, for example. So that money could be gifted over to you for your down payment, as long as you're purchasing, once again, your primary residence. It is not available with conventional financing, particularly for investors. Imani, did you have any questions on this 203K that I may have missed at this point?
No, I don't have any questions about that, but I do have a question about the one-time closed construction loan.
Yes, so really excited about this product. FHA and VA recently came out in the past year and a half, I guess it is, with their own construction loan product, which will allow a buyer, any of our buyers, to find a lot and write a contract on that lot, and then be able to build a new home on top of that lot. Now, one of the things that is different from historical financing when it comes to new construction is that typically you would have to put 50% down payment on the price of your lot. And then you would need to have 10% more on the cost of the build of the home you're building. So that can be quite a bit of cash requirements, as you can imagine, in that situation. Now, what FHA and VA has done is they have said that they will finance the sum total of the two. So let's say, for example, your lot costs $200,000 and you wanted to build a $400,000 house on that. Well, the two added together is $600,000, and you would simply need 3.5% down of the $600,000. And that's how that would happen. And for our vets, who are well deserved, they actually have zero down payment. They can buy a lot and build on that lot for 100% financing. One of the other benefits of the one-time closed construction loan is the fact that, again, it's called one-time close. And the reason behind that is, again, going back to historical financing with the whole 50% down payment and the 10% on the cost of the building, you had to find a construction loan first that would buy the lot for you, and also fund the building of the house. And you had to be approved for that. And then you had to close, therefore you had closing costs. And then once you've accomplished that part, that we'll call that part one, then there was part two, where you then had to come to a lender and find your permanent mortgage that would pay off the construction loan once the home is completed. And again, that required a second approval from the permanent mortgage lender, and it required a second closing, with therefore additional closing costs. So traditionally, prior to this product, you needed to be approved twice, and you needed to pay closing costs twice. Where with this product, it's one-time close, and we're able to approve you one time, and we close you one time at the lot purchase, the lot closing. And from that point on, the home is then built. The home is then built, and then when the home is completed and a certificate of occupancy has been issued, then we internally, as a lender, convert your construction loan to your permanent 30-year fixed rate mortgage, like any other traditional loan. So it's a great way to avoid a lot of hassle with regards to different lenders, with regards to different approvals, with regards to additional closing costs when having closed twice. But with this product, it's just one-time close, one approval, one closing. Additional benefits with the one-time close product is that you're able to finance the house, the construction loan payments. So as the home is being constructed, the monthly interest payments, because that's all there is on construction loans, is interest. Those payments are actually wrapped into the financing itself that we approved you for. So you're not having to deal with duplicate housing payments, where you're living right now versus the home that you're building. So that is gone. Secondly, because you're approved already and you've already closed, you can technically, if life throws, what it throws at all of us, and you should to lose your job, for example, you would still be fine because there's no second approval. As long as you're ready to make those payments and you're back to work or your income is back in place again, by the time the home is completed, you're absolutely fine. No issues. So it's a really great product. Credit score wise, this is really remarkable, frankly, is that we only need a 620 middle or credit score. 620, not 640, not 700, not 800. A 620 score will allow you to build your own home. Again, this product is only available for single family homes. So you can't build a duplex or a triplex or a fourplex with it. However, you can build a single family home that has a basement, for example, that you are finishing. You can build a two-story garage with this product, which of course the second level potentially could be used for living quarters. And again, going back to the theme of accessory dwelling units for ADUs. And why ADUs are so important out here in California is our housing prices are so expensive that it's a great way to supplement the mortgage payment when you're able to rent out that upstairs unit or that basement unit. Single family home, but you are able to build a single family home with a two-story garage or with a finished basement. With regards to how we have the program set up, our relatives have been, those of us that are working with this program, have been identifying lots throughout the Bay Area. And fortunately, right now, new construction in the immediate Bay Area is very limited. People have not been looking at that as an option. Whenever they think new construction, they think about developments that your large builders are building, 300 homes, 200 homes, those kind of, exactly. And in this case, we're talking about lots that are just in between homes, which we call infill lots. And as you drive around the Bay, particularly the East Bay, here in Oakland or otherwise, you will find these lots that are just sitting there. And typically these lots are inherited by other people. There are homes that have been where the house has been burned down due to fire, and or frankly just been condemned due to lack of maintenance. So those are the lots that you're able to be able to identify, and your relatives would be able to help you there, and then also write the contract on. How we plan on to already have permits and knowing how to deal with the architects when necessary. It's not something that we're asking our buyers to have to be experts in or have to deal with. We are I like this lot in terms of the location, where it is, and I would love to build a home on it. In terms of the different types of homes you can build, again, this product allows for your traditional, what we call a stick build, and that's just simply where your builder goes out, buys all the lumber, brings it all back to the lot, and then starts building your home. And that's what most of your homes that you see around here, that's how they're built, traditional stick build. But two other options have been made available with FHA and VA on this one-time close construction loan. That is that you can now put a modular home on your lot, which is cheaper, frankly, than a traditional stick build, because modular homes are built inside of a factory. All the parts of it are. So, for example, the flooring, the walls, the roofing, all of those things that are framed, they're actually done in the factory and then brought out to your lot, where your builder then puts the pieces together to create your final home. So that's a modular home. Whereas your manufactured home, which is your third option that's available. Now, your manufactured home is almost entirely built in the factory. And back in the day, we would all see these half homes coming down the highway, being behind a trailer, and they would be brought to the lot, and then the builder would put it together and then put it on a permanent foundation. So your manufactured homes are going to be your cheapest way to build, and it's really great because it gives our lower income buyers an opportunity to build new as well. So as an example, someone may be able to find let's say that they're only approved for $400,000. They could find let's say, $80,000 lot in Richmond, as an example, which is really blowing up now that they have the ferry terminal out there. $80,000 lot in Richmond, and with the remaining of that $400,000 they've been pre-approved for, they can then go ahead and build a $320,000 house on that $80,000 lot. And 320 probably is going to be a pretty small home if you try to do a traditional stick build. But if you put a manufactured home on there, a $320,000 manufactured home on there, that would work for you. And so you're in a brand new home, and no one's ever lived in it, and it's just a wonderful situation where you're not fighting and bidding with other buyers for the same property as we see out there today. So it's a great way. The other thing that you're going to find, which is really interesting and surprising to most, is that it's actually cheaper to build a new home than it is to buy an old existing home. So when you look at, and what we're talking about is the comparison of square footage cost. So when you look at an existing home, if you look at the MLS listing sheet or the sell sheet for any particular home, they normally will show what the cost per square foot is for that house. And what we're seeing out there is, and this might be somewhere such as East Oakland even, which is still coming up. We're seeing $400 to $450 a square foot for a 70-year-old home. That's 2 bedrooms, 1 bath. Whereas you can build on a flat lot somewhere, on a hillside, a flat lot, for roughly $250 a square foot. So that difference between $250 and $450 is $200 every square foot you're saving, which turns into equity. So if you're building a 1,000 square foot home, as an example, instead of paying $450 times 1,000 square feet, that's $450,000, you'd be paying $250 a square same house, and it's brand new. So that difference between 250,000 and 450,000 is a $200,000 difference,
Huge.
which means equity.
Right.
You walk into a $200,000 equity position that's available if you were to resell that house. You would be able to walk away with it. And keep in mind, this is for a brand new home. So it's actually cheaper to build than it is to buy an existing home, which is one of the reasons why it's really important for us as Realtists, as part of the Association of Real Property Brokers here in Oakland, to make sure this information is known throughout our communities so that they are able to take advantage of this.
Absolutely.
Again, with a low credit score of 620, with a low down payment of 3.5% for our non-veterans, and with 100% financing for our veterans, it really provides for a great opportunity for homeownership. What else can I say about the one-time close? This product is available throughout the state of California, so you don't need to purchase. There's no particular county or just anywhere in California we are able to assist you. And again, the process is very similar to purchasing an existing home. That's simply being you get pre-approved first, you give us a call, you complete an application online, and we pre-approve you based on how much your debt and your income is, based on also what cash you have available. And then at that point, you know how much you can afford to purchase. And you can purchase an existing home, or you can go with the one-time closed construction loan, which that whatever amount you've been approved for, you would need to separate that lot for the price of the lot versus the price of the home that you plan on building on that lot. That's how that would work. So again, going back to the example I gave earlier, the lot's $200,000. Let's say you've been approved for $600,000 total for an existing home or otherwise. You can find a $200,000 lot and then build a $400,000 home on that lot. Now, down payment requirements, once again, with FHA, they want 3.5% for our non-veterans. But one of the things that FHA does allow for is gift of the lot. So if you have a family member, for example, or a close relative, a close long-term associate, family friend, for example, they are able to gift you their lot so that you would have VA is not allowing that in the same scenario. The other opportunity clearly is the fact that, well, FHA and VA only allow for owner-occupied homes to be built. So investors would not be able to do this, with the exception, of course, if they decided to move into this brand new home themselves as a primary residence, and then down the road, maybe a year later or so, then went ahead and resold the property. That would be fine, but initially the home would have to be a primary residence home. I have made available flyers on the FHA VA one-time close construction loan that it will be available, I believe, Monty?
Yes, to everyone that has registered for today's webinar, we will go ahead and send out those flyers and any other slides that Harry has available to you all. So please let us know. And we have a few seconds left, but if anyone had any question or so, please, you can go ahead and put it in the chat box. And even if we can't answer it on here today, we can go ahead and get that question answered to you. I want to say thank you, Harry, for joining us today. This information is very important. Again, as Realtists, we have a special charge, and we need to go and get the information to the community. They do not know that there are products like this out here. They just turn on the news every day and see about $1 million shacks. So they really think that home ownership is unattainable, and we need to show them that it is attainable and that there are various programs and products and people like Realtists in place to help them, to assist them to become homeowners. So thank you so much, Harry. This is great information, and we need to Tell everybody.
Yes, and on the flyers, please download them, because my contact information, you'll find it there. My cell number is 510-395-2344, and I can be reached via email as well at hpayne, that's H as in Harry, Payne,